Now, this is a situation we all find ourselves in at times, and we all end up asking ourselves the same question. We're sitting there with cash that we want to invest, but when we're looking at the markets, we can't help feeling that they just look so high. They've been setting all-time highs for months, and surely they have to come down from here. Surely at some point. So if we just hold on and wait for the markets to drop, or maybe even put in a limit order below the current price, we can just wait and we'll buy in at a better price. I'm not gonna lie, I have these thoughts myself. It's impossible not to have these thoughts in one way or another, because this dilemma is so highly wound up in our own innate behaviors. But in this video, we're going to unpick all that. And I'm also going to be showing you some data that is going to shock most of you. And with this, I'm going to help you work out whether this is a valid strategy that you should be following. Hello and welcome back to the channel. My name is James and this is a place where you can learn to make better financial decisions. I am really pumped about doing this video because this video is entirely the result of your engagement with my videos. YouTube gives me this incredible opportunity. It helps me to help you get in control of your finances. But at the same time, it also gives me a unique insight into how thousands of you are navigating this journey of financial education. And it's your continued comments and engagements with my posts that allows me to learn these things. And the more that I can learn from you, the better I can get at creating content that actually answers the questions that you've got. And I've recently been getting a lot of comments from people saying that they are holding on to cash right now in anticipation of the next crash. And I know that if there are one or two people commenting that type of thing, there are actually hundreds of you doing or thinking the same thing. And I get it, the markets are at all-time highs and surely they have to come down from here. So why not just keep a little bit of cash on the side, and when the markets do crash, you can buy in at a better price. And we can do this systematically simply by setting a limit order that buys us into the market when the price hits a specific target. Now, my inner chimp is telling me that this is a good strategy, but everything that I know about efficient markets and the problems we're trying to time the market is telling me that it's not a good strategy. But to be honest, I've never actually drilled in to the data. So off the back of your comments, I actually went away and back tested this. And to be honest, I was really surprised by what I found. And I know that most of you will be too. There are two distinct parts to this question. The first one is data driven. How likely is it that this strategy is going to pay off? How likely is it that we're going to hit that price target? And we can get a pretty good idea of this just by looking back at historical data. But there's also a big behavioral element to this. For this to work, not only do we need to hit our price target, but we also need to stick to the plan. We need to ensure that we actually press that buy button when the time comes. So in this video, we're going to be exploring both parts of this to give you all the information that you need to decide whether this is a strategy you want to be following. But before we start, we need to set some boundaries for this backtest. Yes, we're holding cash because we think that the markets are going to fall at some point in the future and we want to buy in at a better price. But how much of a drop is going to trigger us to buy in? Well, in a post last week, I asked you guys this exact question. If you're holding cash right now, what drop would you have to see from today's prices to trigger you to buy into the markets? And thank you to anyone that did participate in any of the polls I put out over the last week. I know there were quite a few of them. But as you can see, this was a fairly even split. And over 50% of you said you would need to see a 20% drop or more. And as this is also the most popular opinion, that's what we're going to go with. And to run our test, we're going to need some historical data. Now, I decided to use the S&P 500, mainly because it represents the largest market in the world. And we're going to be looking back at all of the trading days between 1960 and 2021. And the first question we want to ask is that on any given day in this period, what is the chance that the market would then go on to fall from that price by 20% at some point in the future? So firstly, I asked you what you think might happen. And as you can see, there's immediately a bit of a divergence. Now, I actually thought that you would all guess much higher than the actual answer. So I used the options from 40 to 80, but I was obviously wrong. 22% of you thought that the chance of this happening was over 80%, whereas almost 50% of you thought that it was 40% or below. Well, the actual answer is 40.73%. So if you were to implement this strategy at any day between 1960 and 2021, you had a 2 in 5 chance of it paying off. And importantly, the average time that it would have taken to hit that target is 25 months. So just over 2 years, which in my books is quite a long time. I know just looking at percentages can be hard to visualize what's actually going on, but this is what it looks like graphically. Each line here represents a start date that went on to hit our minus 20% trigger. Now, this is not all of the dates that hit that condition. This is just a sample because there is actually a lot more in those same clusters, but this helps you to visualize the timescales that we're talking about. But here, we're just looking at an average day in the markets. And I think we can all agree that right now is anything but average. The S&P 500 set an all-time high, I think, just last week. So this brings us to our second question. If we look back at the S&P 500 over the last 60 years and at all of the days in which new all-time highs have been set, what is the probability that we pick one of those days and then the market goes on to fall from that point by 20%? Now remember, we've just seen what happened with an average day. The chances there were 40.74%, but here we're talking about all-time highs, so we should expect that percentage to be higher. And when I asked you guys this question, there certainly were more votes for the higher probabilities, with 33% of you thinking it's 80% or above, some of you in between, and still a solid 32% who think it's 40% or below. Now guys, this is why I love YouTube so much, and I am so thankful for your engagement with these posts, because it is so fascinating to see that we all have such different images of how the stock market works. And whether these images are right or wrong, it's going to affect the decisions that we make in a big way, potentially. You know, if you think there's an 80% chance the markets are going to drop, well then probably you're going to think sticking in cash is a good thing to do. Whereas if you're one of the people that thinks it's 40% or below, you're not. But the reality is that only one of these is correct. Well, I can tell you that the answer is actually 39.89%. The market is actually less likely to fall by 20% after an all-time high as it is on an average day. The first time I ran this test, I actually only ran it over the last 40 years rather than the last 60 years that we've been looking at. And the findings there were even more surprising. The chances of hitting a minus 20% after an average day was 34.78%, but the chances of hitting minus 20% or minus 20% trigger after an all-time high was 24.52%. That's over 10% less. But going back to our 60-year data, what's also interesting about these all-time highs is that on average, it takes 34 months to actually hit our target. That's almost 3 years and a whole year longer than it would take with an average day. But before we can draw any conclusions, there's 2 more things that we need to factor in here. The first is that 34 months is obviously a very long period. And in that period, dividends will have been paid. And these will be dividends that we would have ultimately missed out on. Now, the average dividend for the S&P 500 has been about 2%. So we need to make sure that we are taking that missed dividend off any potential gains we would make. But if we were trying to do this with something else like the FTSE 100, where the average dividend is more like 4%, well, that could have resulted in us missing out on a lot of dividends. But we also need to remember that this strategy has asymmetric risks. There's a 2 in 5 chance that this strategy could pay off. And if it does, we'll get to buy in at 20% below our starting price. But there's still a 3 in 5 chance that we could lose. And if the market does continue to go up, then our potential downside is infinite. And the reality is that we're probably going to be forced to buy in at a much higher price. But this time is different, I hear you say. Price earnings ratios are higher than they have ever been before. And this is true. If I was to overlay past PE data onto the data that we've just looked at, we would have nothing to compare it with. So yes, maybe you're right. Maybe this time is different, and maybe this strategy has a much higher chance of turning out now. So let's say we do decide that this time is different and we decide to hold on to our cash. What are the chances of us actually sticking to this plan? What behavioral challenges are we going to have to overcome? Well, as we've seen, it's unlikely that this drop is going to come round quickly, and we could be sitting on the sidelines for 3 years or even more. And whilst you're sat there, it's likely that the market is going to be going up, and it's going to feel like you're slowly losing money. Now, of course, you're going to kid yourself that you've not actually lost anything, but you have. And even if you do end up eventually being right, there's probably going to be a period where you're down a lot. So think back to the last time you invested in something new and the weight that you put on how well it performed over those first few months. Now, fortunately, the stock markets go up more than they go down. So this normally works out okay. But in this situation, that mechanic actually works against us. So even if this does end up well, it's going to be a very stressful journey. But then we need to consider what's going to happen when the moment does arrive. The markets are dropping, we've made the right call. It's time to buy in. But everybody else is running for the exits, and doubt starts to creep in that maybe this crash is different, and maybe it's not going to come back, and maybe this isn't such a good idea after all. And if you're nervous about the markets right now, when they're at all-time highs, and you are thinking that this time is different, I'm willing to wager that in the middle of a crash, when everything's falling down around you, you're going to think the exact same thing. And this is the thing that everyone gets wrong. Everyone underestimates the emotional side of investing. And executing a plan like this requires a huge amount of mental discipline. But you're probably sitting there thinking, I'm obviously not going to do this with all of my money. I'm only going to do it with a small bit. So if that does happen, it's not going to hurt that much. I'm not going to get that worked up about it. And yes, I would say that in this situation, you are less likely to make mistakes out of fear. But by God, you can make mistakes out of greed. And I am terrible at this. Recently, I decided to buy a little bit of crypto. It was a tiny amount. And by the way, this is not a recommendation to go out and start buying crypto. But I was looking at the prices and I was like, this stuff is so volatile. I don't want to buy in at the current price. Why don't I just set a limit order that's 5% below the current price? Because surely it's going to hit that. This stuff is flying all over the place. In short, I was being greedy. And within a few days, lo and behold, the market had gone up and I was kicking myself. Why did I do that? Why was I being so greedy? And I was just about to bite the bullet and accept the higher price when suddenly the market started to move down again, and it started to move towards my limit order, getting closer and closer and closer. So what did I do? I reduced my limit order. My God. Honestly, how greedy do you get? This is the thing. I'm a financial planner, and when I'm thinking about somebody else's finances, it's very easy for me to be objective, just in the way that it's very easy for a doctor to be objective about their patients or a personal trainer to be objective about their clients. But when it comes to my own investments or a doctor's own health or a personal trainer's own fitness, we all have to tackle the exact same emotions and biases that you do. Now, I'm aware that my own personal experiences may have clouded the impartiality of this video, but I do know that more money has been lost trying to second guess the markets than has ever been won. And I personally don't like to play games where the odds are stacked against me. But that's just my opinion. I'm interested in what you think. Has any of the data in this video changed your opinions? Or maybe do you think there's another angle that I haven't quite considered here? Please do let me know down in the comments. And above all else, have a good day.